Hey option traders, for today's trade we're looking at an option strategy known as the covered call. In recent weeks we've focused on covered calls in stocks like Starbucks and Dow Jones leader Johnson & Johnson, but this week we're turning our attention over to pharmaceutical leader and COVID vaccine maker Pfizer. Looking at PFE on MarketSmith, the stock has been moving sideways since the end of December. This consolidation action has produced a proper buy point at 61.81, but the stock remains 15% below the entry at this time. Amid the recent market correction, shares were brought below the 200-day, 50-day, and 21-day lines, but last week's rally boosted the stock back above these levels of support. The shares didn't make it too far, though. This week, Pfizer has already come back down to test support at the conjoined 21-day and 50-day lines. One big technical concern for the stock is the pullback occurred in very strong volume, which is a red flag for any bullish investors. However, Pfizer is up over 13% in the last 3 months compared to the S&P 500, which is down 5%. According to IBD Stock Checkup, PFE stock is ranked number 1 in its group and has a composite rating of 99, an EPS rating of 89, and a relative strength rating of 93. With the stock showing a mix of positive and negative signs, it's hard to get 100% bullish just yet. What stands out for Pfizer is its 3.1% dividend yield, which equates to a payout of $1.60 per share per year. Investors may settle into this stock purely for its income-generating potential, so if you have this motive, you could also consider using covered calls to further boost the income you generate with PFE. A covered call is a simple strategy that is designed to collect income while also defining a predetermined exit price at which you'd sell the underlying stock, thereby partly offsetting any decline. So say you buy 100 shares of a stock, covered calls can allow you to lower the cost basis of the long position by selling the call options against your position. To refresh anyone, a covered call is an option contract between a buyer and a seller to purchase a specific stock at an agreed upon price known as the strike price up until a defined expiration date. Remember, with options, there are 2 types. You have calls and puts. With both calls and puts, you can either be a buyer or a seller. Just like with any stock, you can either buy long or sell short. To set up a covered call, you simply need to first buy shares of the underlying stock, then become the seller of call options on that stock, collecting income to offset your cost basis. As the seller of the call option, you're obligated to hand over your shares of stock to the call buyer at the agreed upon price or the strike price, if shares trade above this price at the expiration date. In exchange for this, the buyer of the contract pays you a premium, and any appreciation in the stock above that strike price represents a profit for the buyer. But if the stock instead declines, the buyer would have no reason to exercise the right to buy it for a higher cost. In this case, they'd likely just allow the contract to expire and lose the premium paid. Depending on the option, you could have a number of expiration dates and strike prices to choose from. This, incidentally, is one of the strengths of options. Options provide choices, and investors can analyze a variety of criteria to determine which best fit the needs of their portfolio. Investors must understand that time is a double-edged sword, especially for the buyer. Options contracts decrease in value at an accelerating rate as they get closer to their expiration date. If you're considering putting on a covered call in a given stock, you should first ask yourself, do I believe this stock will trade in a neutral to bullish direction? Am I willing to own this stock even if the price falls a little? If the answer is yes to both of those, then it may be okay for you to proceed in this trade. Covered writing is not simply a buy and hold strategy. It involves thinking ahead about the appropriate action and possible future scenarios. For example, if the stock price declines, where will you sell it and take a loss? If you purchased the stock for, say, $43 a share, but collected $1 in premium for selling a call option, you've reduced your break-even point on the stock to $42 a share. If it continues to fall below that price, it may be better to close out the trade early for a loss. So now that you have a better idea of covered calls, let's take a look at my trading platform and set up a real-life trade together. So here we are on my Thinkorswim dashboard. And to set up this trade, first go to PFE, which is ticker symbol for Pfizer. And if you're on Thinkorswim, you can select your spread type here in this box, which would be covered stock. Then make sure you are on the June 17th expiration date and scroll down until you find 53.5 strike price. which is right here. You're going to be looking at this side of the screen since this is where you find the prices for call options. Simply click on the prices here and the trade should pull up ready to go. We are looking to buy 100 shares of Pfizer and sell one call with a 53.5 strike price and a June 17th expiration. We're interested in buying 100 shares of PFE, which would cost around $5,310. A 53.50 strike call option expiring in June is trading for around $1.50. Selling the call option generates an income of around 2.2% in just a few weeks, which equates to over 50% on an annualized basis, and that's in addition to the 3.1% dividend. If shares close above the strike price of $53.50 on the expiration date, the stock will be called away at that price, leaving you with a total profit of $155, which is the gain on shares plus the $115 option premium you received. Of course, the stock could drop, which would wipe out any gains from selling the call. As always, remember that if you're new to options, make sure you practice with a virtual account before risking any real money. And remember that options are complex and investors can lose 100% or more of their investment. Check out investors.com/options for more option trading tips.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.